Hey everyone, welcome back to the channel. Today we're diving into a topic that affects us all: money myths that keep you poor. These are the sneaky little beliefs that we often hear growing up, things that sound like common sense but can actually hold us back financially. We're gonna break down these myths, expose why they're wrong, and most importantly, I'm gonna show you how to build wealth the right way. So if you're tired of being told you need to win the lottery or inherit a fortune to become financially free, stick around because this video is for you. Let's jump right into the first myth. You need a high income to become wealthy. This is a common misconception that holds many people back from achieving their financial goals. Now don't get me wrong, earning a good income is fantastic, but it's not the only path to wealth, and it's definitely not the deciding factor. Many people believe that without a high-paying job they can't build wealth, but that's simply not true. I mean, think about it. How many people do you know who earn a ton of money but are still broke? They might have a high salary, but their spending habits and lack of financial planning keep them from building true wealth. They might have a fancy car and a big house, but they're living paycheck to paycheck, drowning in debt. Their outward appearance of wealth is just that, an appearance. True wealth is about financial security and freedom. The truth is, it's not about how much you make, it's about how much you keep, and more importantly, how you make that money work for you. This involves saving wisely, investing smartly, and avoiding unnecessary debt. I've seen it time and time again. People with average incomes building incredible wealth because they understand the power of saving, investing, and smart financial planning. They focus on long-term goals and make consistent efforts to achieve them. Take my friend for example, let's call her Sarah. Sarah's story is a perfect illustration of how you don't need a high income to become wealthy. Sarah's a teacher, and while teaching is an incredibly important job, it's not exactly known for its massive paychecks. Despite this, Sarah was determined to build a strong financial future for herself. But Sarah was determined to build a strong financial future for herself. She knew that her financial success depended on her habits and decisions, not just her income. She lived below her means, consistently saved a portion of her income, and diligently invested in low-cost index funds. She educated herself about personal finance and made informed decisions. Fast forward a couple of decades and guess what? Sarah's a millionaire. She achieved this not through luck or inheritance, but through disciplined saving and investing. She didn't win the lottery, she didn't inherit a fortune, she just stayed consistent and made smart choices with her money. Her story is a testament to the power of financial discipline and long-term planning. And Sarah's story isn't unique. There are many people like her who have built wealth through smart financial habits and consistent effort. There are countless examples of everyday people who've achieved financial freedom without six-figure salaries. They focused on what they could control and made the most of their resources. The key takeaway here is that your income doesn't define your financial destiny. It's your financial habits, your mindset, and your commitment to making smart money moves that will ultimately determine your success. It's your financial habits, your mindset, and your commitment to making smart money moves that will ultimately determine your success. Educating yourself and staying disciplined are crucial. So if you're feeling discouraged because you're not pulling in a massive income, don't be. Remember that wealth building is within your reach, no matter your current income level. Focus on what you can control: your savings rate, your investments, and your financial education. These are the tools that will help you build wealth over time. Remember, building wealth is a marathon, not a sprint, and consistent, disciplined action over time is what will get you to the finish line. Stay focused, stay disciplined, and you will achieve your financial goals. Let's move on to the second myth that might be holding you back. Debt is always bad. Now this is a big one, and it's easy to see why so many people believe it. Debt can be scary, it can feel like a heavy weight on your shoulders, and let's be honest, no one likes owing money. The anxiety that comes with seeing those bills pile up can be overwhelming. But here's the thing, not all debt is created equal. There's good debt and there's bad debt, and understanding the difference is crucial for building wealth. Knowing how to distinguish between the two can be a game changer for your financial health. Bad debt is the kind that keeps you trapped in a cycle of payments and interest charges. It's the kind of debt that offers no real benefit and only serves to drain your resources. It's the high-interest credit card debt from overspending on things you don't need, the kind that accumulates quickly and becomes difficult to pay off. The payday loans with their outrageous interest rates, which can sometimes be as high as 400% APR, making it nearly impossible to get out of debt. and the car loans on depreciating assets that lose value faster than you can pay them off. Cars, unlike real estate, typically lose value the moment you drive them off the lot. This kind of debt offers no real return on your investment and can quickly spiral out of control. It can lead to a cycle of borrowing just to make ends meet, which is a dangerous financial trap. Good debt, on the other hand, is strategic. It's about using borrowed money to create opportunities for growth and financial stability. It's using debt as a tool to build wealth, not destroy it. When used wisely, good debt can help you achieve your financial goals faster. This could be a mortgage on a rental property that generates passive income, providing you with a steady stream of cash flow. A student loan for an education that leads to a higher paying career, which can significantly increase your earning potential over your lifetime. Or even a business loan to start or expand a profitable venture. Investing in your own business can yield substantial returns if managed correctly. The key difference between good debt and bad debt is leverage. Leverage allows you to use borrowed funds to increase your potential return on investment. Good debt allows you to leverage other people's money to potentially build wealth. This can be a powerful strategy when used correctly. For example, let's say you buy a rental property with a mortgage. You're using the bank's money to acquire an asset that generates income and appreciates in value over time. You're using the bank's money to acquire an asset that generates income and appreciates in value over time. This can be a smart way to build wealth over the long term. As you pay down the mortgage, you're building equity and increasing your net worth. Each payment you make brings you closer to owning the property outright. Of course, taking on any kind of debt, even good debt, requires careful consideration and planning. It's important to understand the terms and conditions of the debt and to have a clear plan for repayment. You need to make sure you can comfortably afford the payments, that the potential returns outweigh the risks, and that you have a solid plan for managing and eventually paying off the debt. This involves budgeting, forecasting, and sometimes seeking professional financial advice. So the next time you hear someone say, debt is always bad, remember that it's not that simple. Debt can be a double-edged sword, and it's all about how you wield it. Debt can be a powerful tool for building wealth when used strategically and responsibly. It's about making informed decisions and using debt to your advantage. Just make sure you're using it to your advantage, not letting it control your financial future. With the right approach, debt can be a stepping stone to financial success rather than a stumbling block. Chapter 3. Myth 3. Investing is just gambling. Alright, let's tackle the final myth that might be keeping you from building wealth. Investing is too risky. This one's a classic, and it often stems from a lack of understanding about what investing actually is and how it works. Many people equate investing with gambling because they see it as a game of chance where you either win big or lose everything. People hear stories about stock market crashes, risky investments, and people losing everything, and they think, nope, not for me, I'd rather keep my money safe and sound under my mattress. They imagine the worst-case scenarios and let fear dictate their financial decisions. But here's the truth. Keeping your money in a savings account, or worse, under your mattress, is actually one of the riskiest things you can do with your money. Why? Because of inflation. Inflation is like a slow leak in your financial tire, gradually deflating the value of your money. Inflation is the silent wealth killer that erodes the purchasing power of your money over time. What you can buy with $1 today will be less than what you can buy with that same dollar in the future. If you're not investing your money, it's actually losing value year after year. The cost of goods and services increases, but your money remains stagnant, effectively shrinking your wealth. Investing, on the other hand, is about putting your money to work for you. It's about making your money grow and multiply over time, rather than letting it sit idle. It's about participating in the growth of the economy, owning a piece of successful companies, and building long-term wealth. When you invest, you're essentially becoming a part owner of businesses that drive economic progress. Yes, there are risks involved, but with the right knowledge and approach, you can manage those risks and position yourself for financial success. Educating yourself about different investment strategies and understanding market trends can significantly reduce the perceived risk. The key to successful investing is diversification and a long-term perspective. Diversification is like having a safety net. It spreads out your risk across various investments. Diversification means spreading your investments across different asset classes like stocks, bonds, real estate, and even alternative investments. This way, you're not putting all your eggs in one basket. This helps to reduce your overall risk because if one investment performs poorly, others can potentially offset those losses. It's a balanced approach that can provide more stability to your portfolio. Having a long-term perspective is crucial because the stock market, like life, has its ups and downs. Short-term fluctuations can be unsettling, but they're a normal part of the investment journey. There will be periods of volatility, but over the long term, the stock market has historically trended upwards. By focusing on the long-term horizon, you can ride out the short-term storms. By staying invested for the long haul, you're giving your investments time to ride out those fluctuations and potentially grow in value. Patience and persistence are key virtues in the world of investing. Now, I know getting started with investing can seem intimidating, especially if you're new to it. The financial jargon, the myriad of options, and the fear of making mistakes can be overwhelming, but trust me, it's not as complicated as it seems. With a bit of research and the right resources, you can demystify the process and gain confidence in your investment decisions. There are tons of resources available to help you learn the basics, like online courses, books, and even financial advisors. These tools can provide you with the knowledge and guidance you need to make informed choices. The most important thing is to start somewhere, even if it's just with a small amount of money. Starting small allows you to learn and grow without taking on too much risk initially. The earlier you start investing, the more time your money has to compound and grow. Compounding is the process where your investment earnings generate their own earnings, creating a snowball effect over time. Remember, time is your greatest asset when it comes to building wealth. The sooner you begin, the more you can take advantage of the power of compounding, setting yourself up for a more secure financial future. Thanks for watching. If you found this video helpful, make sure to hit the like button and subscribe for more tips on building wealth. Remember, building wealth is a journey, not a destination. It's about making smart choices consistently over time. So, stay informed, stay disciplined, and never stop learning. See you in the next video.